Hello and welcome to Business Weekly. I am Umar Kaltungo. Now in this edition of the show, from the International Monetary Fund again came a warning on Nigeria and two other African nations' rising public debt stock, projecting that a whopping 60% of these countries' revenues may be used up for debt service, with only a paltry 40% to contend with running of government and service delivery. Nigeria's public debt as at the end of September this year is put at about 20 trillion naira, according to data by the Debt Management Office. Now, only recently at the annual meetings of the IMF and World Bank in Washington in October, the two World Economic and Monetary institutions gave the same warning to Nigeria and other sub-Saharan African countries to slow down on debt accumulation. The IMF stressed that the economies in the region are driven by large fiscal deficit and depreciation, while debt stocks have risen throughout the region. Now, the multilateral financial institutions also reveal that debt stocks have risen throughout the region, while debt service costs have increased. Well, this will be the focus of our show today. Now, the growing debt profile of the federal government could be worse and needs to be carefully managed. The IMF has warned us. It is said in its 2017 economic outlook that public debt rose above 50% of gross domestic product in 22 sub-Saharan African countries at the end of 2016 and could rise to as high as 60%, which is in countries that had hitherto depended on oil, especially in Nigeria, Gabon, and Angola. Senior resident representative and mission chief for Nigeria Africa Department of the organization, Mr. Amine Mati, who presented the report entitled Fiscal Adjustment and Economic Diversification, urged oil-dependent economies to urgently diversify. The IMF chief said debt stocks have risen throughout the region, noting that exchange rate pressures have eased in many countries, as is the case with Nigeria, where debt has risen to as much as 20 trillion naira. While urging actions to avoid crowding out the private sector from the capital markets in the region, he said diversification of their economies and fiscal consolidation were an imperative in the African region. The multilateral financial institutions also revealed that debt stock have risen throughout the region, while debt service costs have increased. It pointed out that what the region required was getting the policy mix right and playing to their strengths. Our correspondents in Abuja were at this economic forum.
The pickup overall is still modest, was going from a 1.4% growth in 2016, and we expect that to be 2.6% on average in 2017. Two economies explain this. One, Nigeria, big surprise. South Africa is the other one, where it also had one-off factors with strong agricultural production and mining production. Those two countries have helped explain some of the big pickup that we've seen. At the same time, we have an easing of drought conditions in some of the Eastern Africa countries, which have also contributed to this rebound. But if you look at the growth projections, 2018, we have an average of about 3.5%. If we were to exclude Nigeria and South Africa, we have 5%, but that's because the Eastern African countries on average were already growing much faster. Now, is that enough? We have 45 countries in sub-Saharan Africa. Of those 45 countries that we cover, if we were to look at GDP per capita, we will find that the recovery and the growth numbers that we have are not enough. We have 12 countries out of the 45 that are seeing falling per capita GDP. That represents 43% of the population of those 45 countries, and a large part of that 43%, Nigeria is in it. So the recovery is there and it's subdued, but it's still not enough because per capita GDP is still low. And if we were to look at excluding Nigeria and South Africa, we would have 5%. And if you were to look at the risks to this outlook, we would call it balanced. and balanced because of two reasons. We think that external conditions are positive. We have growth in key trading partners that are turning out to be more durable. And then on the downside, well, if oil price were to go down, a lot of the countries in our region depend on commodity developments that also affect the non-commodity economy. Or if there was a tightening in global financial conditions, the outlook risk would be to the downside. Now, on inflation, developments for the region have been positive. There's been a 2 percentage point decline for both headline and food inflation. Some of it is reflecting tighter monetary conditions in Nigeria, Angola, and and Tanzania. You have some improvement also in exchange rate market conditions. There's been a spike on food. The spike that you see on food in the 2016-17 is explained also by what happened in East Africa when there was some periods of drought that also picked up inflation. Now, why growth matters? We know growth matters, but let's try to link growth and look at some of the human development indicators, which are important. In 1990, we have GDP per capita of about 2,600. Life expectancy was 50. Since then, life expectancy has increased to 3,400 as of 2015. Important progress in these human development indicators have happened also because of better access to education and health services and reforms in those areas, but it also because economic activity has been able to pick up. So we have a halving of the maternal mortality rate, of the infant mortality rate, but that's still not enough. I mean, complacency cannot occur. More growth is necessary. So now let's try to look at the factors underpinning this subdued outlook that I talked about. Well, on the positive, global growth is expected to be around 3.5%. And that's been higher than expected in both the Euro area and China, and has been strong in India. Those three different groups of economies between Europe and East Asia account for the bulk of exports of the region. So that's good news. Another good news is commodity prices, on which a lot of the region depends, and commodity prices have been going and moving trendward. And that's not just for oil, but also for other capacities. And then one interesting characteristic of these global financial conditions and this global growth going on is what we have observed in terms of external financing costs that have decreased considerably. You look, in January 2016, we had spreads of about higher than 1,000 basis points. Today, when Nigeria is about to embark on a roadshow and try to access international markets for the region, and this is sub-Saharan Africa, and let me flag that this excludes South Africa in this frontier index, we have spreads at about 500 basis points or slightly lower. So this big improvement encouraged access to international markets, and we see that clearly with the number of international bond issuances. Both oil exporters, you saw oil exporters who were affected in 2016, like Nigeria. Nobody went to the international market in 2016. Too expensive, and it was not available given the financing difficulties. That's not the case in 2017. So we went, and these were the non-oil exporters that went, was $750 million in international bond issuance in 2016 to $4.5 billion, and still counting so far in 2017. And of that, in the oil exporters, you find the $1.5 billion of Nigeria. And the other countries would be Cote d'Ivoire and Senegal that also were able to access markets at very, very favorable conditions. This favorable international market has also contributed throughout the region in trying to reduce pressures on the exchange rate and on the currency. And on this case, we have to look at two factors. the global factors really explain a lot of the external financing coming in. To other countries, you have trade factors that have come in where you have a trade surplus and more availability of foreign exchange. And also tight monetary policy has contributed to that, and I'm sure Dr. Nana will talk about that. And given that we're in Nigeria, I thought might as well use the example of Nigeria, which is one of the countries where we've seen the most progress in this area. And it's clear that in February 2017, we had the parallel market premium of about, we had Naira at 500 Naira, we had parallel market premium of about 60%. And that has been reduced to about 20% today. What happens on the fiscal side? Fiscal deficits are high for the region as a whole. You find that the average is about 4.5%. For the oil exporters, there's been some slight improvement for some of them, except for Angola and Nigeria, where we still expect the deficit to be around 5.5%, so a bit worse than last year because of the non-oil revenue shortfall that will keep dominating the outcome. But it's not like the other resource-intensive countries, which is those that are rich in mineral and other commodities, are doing much better. And some of them because of a slower economic activity or because they have not been able to, rein in some of the current spending. Now, in these oil exporters, for those that were able to reduce their deficit, one characteristic that we noticed is that they were able to do it by cutting capital spending, which is not really the way to go if you want to try to protect growth. On the external side, current account is improving for the oil exporters across the region, but we have to here look at two different characteristics. First, for the oil exporters, it's clear that you have the current accounts that is going into surplus. That is two factors here. One, for some of them, the commodity prices have picked up again. And then the other one is that there was a lot of import compression for the adjustment. Case in point was Nigeria, where there was a 33% decrease in imports. That contributed to the current account balances improving. But then, if you look at the importers, the non-resource intensive countries, we see that the deficit is still high, on average about 8%. Now, is that a concern? Or when we look at the countries in this group, it's less of a concern because a lot of this current account deficit has been financed by long-term foreign direct investment, which helps reduce the vulnerabilities. Sub-Saharan Africa used to experience before has been easing. Now we have growth that is expecting to pick up between 1.4% to 2.6% for next year on average, and then 3.5% in 2018. That is much improved growth rate due to Nigeria, one-off increase on oil production and agriculture, also in South Africa. So those two countries have been driving the outlook up. Of course, that growth is better than what it was, but not sufficient to reduce unemployment and poverty. And this is the reason why you need to take more measures to try to promote growth. The Economic and Recovery and Growth Plan for Nigeria is one of those. The other countries have done it with fiscal consolidation and also export diversification, which is going to help those countries go to another level of growth. And that's necessary because otherwise per capita growth is falling.
Flip side, however, the IMF commended the Central Bank of Nigeria for soaking up the foreign exchange pressure in Nigeria, noting that though debt stocks have risen throughout the region, but that exchange rate pressures have eased in many countries, citing the case of Nigeria as a practical model. The world body described as subdued the current growth in many parts of African region and expressed optimism that the future will be positive if the region depends less on oil commodities export. World GDP growth, according to the IMF, could rise to about 2.6% at the end of 2017 and rise to as high as 3.4% in 2018.
If you look at the graph, though so small, it tells the entire story of our past economic dilemma. Dilemma as a monoculture economy. We depend mostly on oil production, crude oil to be specific. Crude oil is a curse. The Dutch disease is real. And if I have it my way, and most of my compatriots, we would have told the oil to go away. Commodity price, namely oil price. When production goes up and price is sustained above $60 per barrel, the exchange rate performs exceptionally very well. Most of my compatriots equate the exchange rate as a symbol of strength. Namely, when the naira is strong, exchanging at parity with the dollar, then Nigeria as a nation is strong. Wrong. This is wrong. Very wrong. If this were to be true, two economies, Japan and China, should be putting their currency, the renminbi and the yen, at parity with the dollar. But that is not the case. It isn't the case. In whatever thing we do, whatever policy we evolve, the exchange rate must reflect the fundamentals of the economy. And oil definitely is not the fundamental of Nigerian economy. Every month, the money from oil, which is exogenous, is pumped into the economy. It is shared along the three tiers of government. Liquidity is built up. Everybody is happy. But the sad thing is that everybody gets drunk and the barman is not paid. So it's the duty of the central bank to ensure that we operate in an environment of optimal liquidity. Not too much and not too low. So in 2017 to date, we have drained a total of 3.2 trillion naira. This is money which would have been pumped into the system to chase goods and services, particularly foreign exchange. Everybody here cries about, I went to my bank to get foreign exchange, I didn't get foreign exchange. How do you get foreign exchange if you do not export? If you only export oil and the oil price is coming down and production is declining, so where will you get it? Uncle Sam hasn't given us the power to print dollar. Maybe one day they will ask us to print dollar on their behalf. But until they do that, you can only get the dollar that you earn from exports. And it's our duty to make sure that your reserves are well managed. So you can see the problem we have. Central bank has to embark on heterodox policy. No free lunch, and in fact, anything free may be dangerous to your health. It's like the free air is free, it's supposed to be free. And if it's polluted, then you're in trouble. And we are doing everything in Nigeria to pollute our air because nobody cares. It's a free good. And every free good, you have to be very careful consuming it. But in Nigeria, I was saying that in respect of our responsibility as a citizen. And that responsibility is a duty we owe to civil society. We must pay our taxes in whatever thing we do. Nigerian economic, I see optimism, hope, and hope. And in fact, 2018 will be far much better than 2017. Every indication is pointing towards it.
Now, before we go, let's take a look at a holistic review of activities on the floor of the Nigerian Stock Exchange at the close of business last Friday. Now, a total turnover of 2.804 billion shares worth about 54.776 billion naira in 17,792 deals were traded last week by investors on the floor of the exchange, in contrast to a total of 1.316 billion shares valued at 13.784 billion naira that exchanged hands in the preceding week in 19,169 deals. The financial services industry, measured by volume, led the activity chart with about 2.352 billion shares valued at 8.995 billion naira, traded in 9,364 deals. Those contributing about 83.88% and 16.42% to the total equity turnover, volume and value respectively. Can take in this edition of the show. Join me next week for more, as we now leave you with graphics of the activities, of a review of activities on the floor of the Nigerian Stock Exchange at the close of business on Friday. Very many thanks indeed for watching. I am Omar Kaltungo.